Hello, folks. It's Friday. Welcome to Pro Trader Strategies, and we are an educational company. So if you want to learn about the markets and trading options, please hit that subscribe button. Also, make sure you click on that notifications because when I come on, I might be doing it at the spur of the moment on a trade that I've done so that you'll catch that live. You'll get a notification. So click on that, please. Finally, throughout this video, over there in the comments section, feel free to reach out if you want me to look at a stock for you or you have a question about anything I'm talking about. Feel free to reach out over there in the comment section because I will try to answer those questions during this live broadcast. And folks, I'll circle back around later and make sure everybody's clear at concept. So if you have anything you want to talk about there or cover in future webinars, you know, that comment section is where I'm going to be keeping my eye. And finally, smash that like button. It does help us out. And let's get on with the economic data. Across the pond, we've got not a whole lot of economic data, but here in the United States, something we saw, we got a bit of a blip to the upside in the equities early this morning when we got economic data from core retail sales. Now remember, core retail sales, we're going to strip out autos, and this is what the real retail trader or retail person is buying. That's the consumer. It's not going to be the service sector being a part of this necessarily. But the core retail sales, stripping out autos, coming in at 1.3%, expected to be at 0.4%. So almost beating by a full percentage point on the core retail sales. Now we add back in autos, and we know all about this chip shortage, the F-150s, all of those things. We would expect autos to come off a little bit. Well, we were expecting it to come off retail sales with the autos added in. We were expected that number to come off by basically a negative 0.4%. Well, we knocked it out of the park, coming in at positive 0.6%. So another full percentage point beat on this retail sales number. That should have given us a lot of oomph to the upside. The consumer is out there in force buying, despite the fact that in the University of Michigan consumer sentiment, which isn't always the best gauge of the consumer, comes in at 80.8, expected to be 86.5. So it is much lower. That would lead us to believe that if the consumer isn't very confident, they wouldn't be spending like this. Well, in this case, I guess we're doing some binge spending because that showed up in the retail sales number, despite the fact that consumer sentiment is coming off a little bit. Usually that is not what we see show up there. And then business inventories coming off a little bit to 0.5%, expected to be 0.6%. Not surprising after seeing those gangbuster retail sales and core retail sales numbers. And University of Michigan inflation expectations, 4.8%, folks. That is pretty darn high. I mean, those are some serious expectations. Remember, we used to think 2.5% was what the Fed wanted to achieve. Well, that's done and over. We are at 4.5% there. Almost 5%, to be quite honest. Closer to 5% than 4.5%, really. All right, let's look at the overall markets. And remember to share the screen. We are good to go. We've got crude oil. They made that bounce at around 6, or had that sell off at around 6:30 as well. You can see we got the bump at around 5:30 on the economic data, but then as soon as the equity markets opened up, basically everybody came in selling with both hands. Now we are starting to get a little bit of a bounce here right back to the open mark here. So we are in positive territory, making a bit of a strong comeback. As you can see here on this low, just 16 cents away from testing that 60 handle, or, you know, it's with the 6 handle on it. So we were real close to that. I thought we might start breaking down there, but the strength is coming back into the markets right now. Bonds are coming off a little bit with the way the market's been rallying in the bonds. You know, the 10-year going below 1.3%. Bonds, interest rates are dropping as well. It's right there. It's going to get, interest rates are going to get a little too low, I think, especially for the inflation that's going on here. If we start going with bonds much higher than we are right now. Bitcoin's finally finding a bottom. This 30,000 is really being defended by the folks that are trading this. The volumes are starting to dry up a little bit here, but they are really defending that market right there. All right, gold holding on to 18 handle. We are starting to fall. Yesterday was looking pretty bearish. Today, the confirmation. You get these setups here. These are the candles that I'm always looking for. You got this hangman doji here and then a confirmation. That is quintessential topping pattern and opportunity to get short? Well, folks, I've been long gold, so we'll talk about that in the form of GDX here in a minute. The gold making that move to the downside, I decided to pull the ripcord on my longs there. And VIX is higher. We're holding on to the teens again, and that's because we got a bit of a mixed bag. NASDAQ was very close to coming into positive territory here, but you can see now we are closer to the lows of the day. We can break this down into the 15-minute chart, and it's going to look very similar. You get the bump at 530 just a little bit, and then the equity markets open up, and we start to see the institutional investor coming in selling with both hands. That's usually that sign. You start seeing markets free fall like that. That's usually due to the fact that when the market opens, there is a lot of sell orders from those institutions. And we've got the Dow Jones Industrial Average off, but only 100 points, and continuing to get these patterns here. Now, finally getting up to that point where we've got basic tweezer tops here on a chart pattern that would look like tweezer tops, and these slowing momentum candles are indicative of this market wanting to roll over. So I'm looking for equities. I would say the risk is to the downside in equities for the remainder part of at least today. And you can see E-mini S&Ps got the candle yesterday, the Hangman Doji. Today it's a little bit fuzzy, not really any confirmation, only because it made that little bit of a top there, newer high. But if we finish, let's say, somewhere in the vicinity of handling 4,300 even in E-mini S&Ps, 4,300 even or below is going to make this look like we've got a confirmation pattern on a top in E-mini S&Ps. So we can see this show up again. Equities pretty strong overnight on the economic data, got a little stronger, but soon as the markets open for on New York, market just slammed. I mean, there was a lot of sell orders. I would have to say that the market may get a dead cat bounce where we start getting, may up to 43.50, but I think that dead cat bounce is going to start rolling back over after the weaker hands here in this massive sell-off are going to be dying to cover those intraday trades there. All right, so let's get on with the trades that I've done. NVIDIA, you guys have been playing along with this. We did this for the synthetic short webinar, and I talk about the rules in and around why we would set this strategy up like that, and it basically came to fruition. I was worried about volatility spiking if we started selling off. I had a bearish market assumption based on the chart pattern we've got right here. And we've got these topping patterns. It's kind of similar to what I was just talking about in the E-mini S&Ps, where you start getting these patterns that look like topping patterns kind of bunched up in a line together. That's where the bulls and bears are really fighting it out. Then we started getting this confirmation candle here. That's when I decided to get short NVIDIA with a synthetic short. And why I picked the synthetic short is because I wanted to avoid all theta decay. I wanted to really create a short position for NVIDIA. So like dollar for dollar, I would profit from a move downward. And that worked out. We got the confirmation, a drop. Yeah, it got a little bit of a bounce, but today, or this week, I should say, really seeing that weakness come in. So I've been scaling out of this. Usually I like to pull the ripcord on everything all at once on these, but this was, I got pretty overweight on this short when I did it. So I decided I wanted to take a little bit of profit as we started selling off here. So I've covered a third, and still have a third of this trade on with the synthetic short. And I did this in the, the September, because I wanted to get the longer duration, right? So September, longer duration. I don't have to worry about theta decay because with a synthetic short, you're basically counteracting theta and you're counteracting the vega, and we build it so our deltas are negative 100 here. And that would be like selling 100 of the underlying. Every dollar it goes down, it's a dollar profit. So with that said, I did the September and I bought the 830 puts in there and then sold the 830 calls. All right, that I originally did for $5 and I think 80 cents right off the bat. That was a debit. So basically my break even is, let's just call it 825 there. Just so it's 824.20 or something like that, right? with the debit I paid for the original trade of 580, let's say, I subtract that from the strike price to get where my break even is. Well, when you're doing it with a synthetic short, folks, you're really getting a strike location where you might not otherwise be able to do in the open market. For instance, right now we're looking at NVDA trading right around 742. Well, with the synthetic short, I might be able to get short at 743 right now using options. You can't really do that in the stock. You're basically going into the open market and selling it there. But with these strategies, I show you how you can build them out so you can get a strike location like that, or a short position at a price that might not have otherwise been traded. So I'll show you how to do that in there. But with that said, remember yesterday I covered a third of them for about $55. Today I covered the trade for $86.10. All right, so that puts my out on this trade right around, you subtract the 30 and so at 74. So 774 is where I bought this third of a tranche back in. You can see it's a little bit better than where we are right now, but I'm scaling in. So I covered some of them at synthetically. Yesterday it was 775. Today it's basically right around 744-ish, if I'm doing the math right in my head. So I still have a third on. I'm going to let that ride out. I think we might come down and clip off of this Fibonacci. So 715 would be an area where I'm going to be looking to cover if we start seeing some weakness. That might happen next week, but any type of turnaround, I'm going to be looking to jump out of my NVIDIA. GDX following gold. We saw that real top pattern in gold. I don't think it's going to recover. It might even be losing the 1800 handle here in gold as we're seeing the strength in the dollar. And I've talked about how bizarre the gold futures were moving higher despite the fact that we were seeing stronger dollar. Well, it's following inflation expectations, right? Well, it's today it started to break, and all the levers and the pulleys in the markets that really should have been working for this came to fruition, and we started seeing the market fall off. So I decided to pull the ripcord on this. And I had on the September longer duration, trying to limit that theta decay. I just bought calls here on this trade to get that directional move. And I bought the SEP 35 calls in there originally for $1.26. Yes, yesterday was much better. Got out of it today for $1.33. Slight profit. All intents and purposes, I would call that a scratch. If I lost 2 or 3 cents on a trade, I'd call it a scratch. I only made a few pennies on that trade, so I'm calling that a scratch. But scratch for me is a winner in my eyes. And then finally, I added the city trade for the webinar that we were doing on the calendars. Basically, this is the put calendar. I want to advance on a downward move here. And I've been playing around, keeping an eye on this for a couple of days now, wanting to add it. Was talking about the 65 handle in the webinar for the calendar. Basically, we're doing the Augie-Ock put calendar in there. So I'm looking to go out in the longer duration, buy those puts. So buying the October 62.5 puts in there. And then I'm financing those by selling the August 62.5 puts. Calendars are using the same stretch, selling the nearer duration, buying the further duration. I will never show or speak of doing a short put calendar or a short call calendar, because that means you're getting short, longer duration options, and I don't believe in that. So I won't even talk about that. I will never trade that. So the long put calendar is what I look at for these type of trades. That said, I did for Citigroup here. We did the Augie-Ock and going out in the October, bought the 62.5, sold the August 62.5 puts in there, and I did it for a debit of $1.19. Now my reward on this, my upside profit, is if on expiration in August, basically August 20th, at expiration, if the city is trading just a penny above, so basically trading at around 62.51. So I'm basically getting my short calls 1 penny out of the money. so they expire worthless. Well, then I gain on the entire movement to the downside to 62.5 by those long puts. They gain in value for that move, while the theta decay should erode all the premiums. And if I can get that short call, or sorry, short put to settle out of the money, then I basically get the full width of that spread. So actually, I said 62.51. I'm at 49, so 1 penny just below there. And then I can cover. What I'm going to look to do in these August, if I can get out for a nickel for my short calls, then I'll do that, ride out the long calls, maybe even, like I talked about, roll out and down on those short puts, make it into a diagonal or a just a long put spread by selling another one. It might be in the same month, might end up landing in that October month for me. So that's where it would end up turning into a spread by rolling out in time, lowering cost basis, increasing my probabilities of success. That's what we do. Stay mechanical here at Pro Trader Strategies and follow the process, okay? That's what I'm trying to do for you guys. To find the right strategy, we follow a process. We look to be good stewards of our capital. Are the premiums expensive or are they cheap? And that's going to determine whether or not I'm buying or selling options. With this one, with the calendar, we actually look at how the volatility is impacting those premiums, and we can really look at the option montage and decide, hey, some of these options are cheap and some of them are expensive. That's exactly what I did with Citi. The ones I was buying were super cheap, and the ones I was selling were a little bit more expensive. So I was able to shift that paradigm where I was buying low and selling high at the same time. And I show you how to spot those opportunities in that webinar. So please check that out at Pro Trader Strategies. And if you have any comments throughout that webinar, I'm circling back around for you there. So comment. I got you folks. All right. Also, don't forget to hit that subscribe button and the notification on there. Make sure you get set a reminder. If I go live, it'll send it to you, and we'll be talking about those live trades then. All right. And have a great weekend, everybody. Finally, give me a smash that. Or take that. Take it easy. Have a great weekend.